Okay, let's start. Hello, everyone, and welcome to this third and final panel in the Group of 78's 2022 Annual Policy Conference on Transforming International Finance Toward Economic, Social, and Planetary Justice. Yesterday, we had a lively discussion on transforming banking, monetary, and fiscal policies, which explored, among other things, the huge potential for public banks, including postal banks, to meet economic and social needs that are typically neglected by private sector financial institutions and by public-private partnerships. Today, our panel will delve into transforming financial innovation. Our panelists will address the opportunities as well as the threats of financial innovation, such as cryptocurrencies and central bank digital currencies. Must such innovations be sources of speculation, instability, and growing inequality? Or can they actually be regulated to work to serve social needs and the public interest? How can finance be democratized? Well, we're calling on our expert panel to address some of these very challenging questions. Unfortunately, I have to inform you up front, one of our speakers, Andres Araus, unfortunately could not join us due to complications in his travel schedule, but fortunately was able to send us a video of what he was going to say. So he's going to join us virtually in another way for this webinar. So onwards, our moderator for this panel is Mario Seccareccia. Mario is Professor Emeritus at the Department of Economics, University of Ottawa, where he taught for 40 years, from 1978 to 2018, in the fields of macroeconomics, monetary theory, labor economics, history of economic thought, and economic history, areas in which he has also published extensively. He has been visiting professor in a number of universities in France and in Mexico, and he participates regularly in policy debates in both Europe and North America. So Mario, over to you for introductory remarks and to introduce the speaker.
Excuse me. Thank you, Roy, for your remarks, and I'm most grateful to both you and the other members of the organizing committee of this conference, and to the Group of 78 for sponsoring this. I want to start with a little statement. Mention about the history of economic thought, and there was a famous Austrian economist, Joseph Schumpeter, who showed that all new inventions and what he calls the follow-up entrepreneurial innovations, that tend to ensue from these inventions, can have very positive or beneficial externalities, if you wish. But also, of course, they could have very negative or detrimental externalities. And he did so through his analysis of what he referred to as creative destruction and all that. This is all this sort of vocabulary that comes from that literature. And this last session here of the conference, titled Transforming Financial Innovation, is on exactly how, policy here can be better shaped to maximize the beneficial effects while protecting society, of course, from the detrimental effects of these financial innovations that have affected, and are affecting our society. Especially over the last decade. I mean, many of you will remember what happened during the global financial crisis, where through derivative market that went somewhat wild there, and with toxic assets and all that, which was one form of financial innovation that just derailed, as we know, during the financial crisis. And what we've seen over the last decade, especially with the invention here of these new types of blockchain kind of technology that has been set up for essentially implementing new forms of means of payments. Okay, that we're seeing, of course, many of the challenges again. Okay. In this case, the focus of this session will be primarily on the challenges faced by both our domestic and international payment system because of the emergence of digital, transaction technology here and its embodiment, for instance, in these cryptocurrencies. Now, I kind of went up and checked in the Oxford Dictionary to understand what are cryptocurrencies. What is a cryptocurrency? And I'd like to quote what it says here in just 2 words here. It says here, a digital currency in which a cryptocurrency is a digital currency in which transactions are verified and records maintained by a decentralized system using cryptography rather than by a centralized authority. Now, that's an interesting definition here. That sounds very clinical almost in a way. But, in a sense, cryptocurrencies are, to me at least, they are digital assets, okay, that people use either as a financial kind of investment or financial holding, of savings and all that, or for online purchases if you spend your savings from your electronic account or electronic wallet that they would set up for you in order to engage in that transaction. Hence, to use a cryptocurrency, you have to give up in exchange a real currency, like dollars, let's say the Canadian dollar in this case, to buy a virtual coins or tokens of a certain kind of cryptocurrency. And therefore, there are all types of these cryptos around. There are many categories of them. I will not discuss them here, but just to say that they are, and perhaps Ulrich might be one of our speakers here might mention something about that as well. Now, a cryptocurrency is a peculiar type of digital financial asset, which is an alternative form of payment created using what they call encryption algorithms or blockchain kind of technologies. Okay. And the use of these encryption technology means that cryptocurrencies function both as a currency and as a virtual accounting system, of these transactions that may take place. Moreover, to use cryptocurrencies, you need a cryptocurrency wallet by dealing with a broker or some online platform where it could be accessed. Now, because of the tedious encryption process, the so-called mining of these assets requires a lot of computer energy with all sorts of ecological questions around that, as people know. Furthermore, all transactions are verified through a kind of peer-to-peer network of computers that participate in the initial mining and verification or circulation process. Now, the most well-known, of course, is the Bitcoin, and that was launched in 2009. And it's just one example. There are many here that now have emerged. But I should just mention something about the Bitcoin because, of course, it has been adopted by at least 2 countries internationally, okay, officially, at par with their own respective currencies. That is to say, El Salvador, of course, and the Central African Republic. Which, by the way, without disrespect, they're also, you could call almost banana republics here in a sense, and it's sort of ironic that it's not adopted generally at all. Okay. Now, what I should say about Bitcoin, though, is that it's not unlike the way they were setting up even with the gold standard in terms of its scarcity value. It was actually set up by a rather peculiar, indeed, his identity is really unknown, the guy who invented the initial one, which is Satoshi Nakamoto, a Japanese inventor, okay, who was the alleged, as I said, creator of this. Now, in the source code, Nakamoto set up the upper limit to total units of this Bitcoins as 21 million Bitcoins, implying that no more can be mined or circulated, therefore. Now, what this does is creates a specific artificial scarcity here. And currently there are only about 2 million left to be mined out of those 21 million, as an example, which is, in a sense, if we were to base our system on these Bitcoins, it would mean that we would have a deflationary bias here, okay, as was the gold standard, in a sense, under, let's say, in the 19th century type of world, okay? Because, of course, it means that we would have the value of the currency guaranteed to go up as long as demand continues to grow for these currencies, okay? Now, we are told, at least it is marketed, that some 60% of the people who use cryptocurrencies for transactions have annual incomes lower than 50,000 US. Okay, so it actually is used primarily by those young people, first of all, a lot of young people primarily, that are of a lower income sort of category, so to speak here. And furthermore, they tend to be people who are unbanked. That is to say that they cannot easily access banking services, which is of interest here. Okay, so it does fulfill a certain need out there, especially in the developing world, where access to banking services are more limited. Okay, now there are various characteristics of this the so-called cryptocurrency, and we are told again that it's marketed that it fulfills all the 6 characteristics of money that we are told. One of them being durability, portability, divisibility, fungibility, scarcity, and acceptability. However, is it really money? Well, the last one about acceptability, of course, is that there's a lot of questions about that. It's certainly not, for one thing, it's not legal tender in most countries of the world. It's not, except for 2 countries, in the case of Bitcoin, for instance. Okay, and what if you want to buy, let's say, an ice cream, as we saw with Pierre Poilievre, who was promoting it a while back? Or if you want to buy a car? Well, you only have 2 options when purchasing, say, a car with cryptos. You can purchase from a dealer that accepts virtual currency, or purchase it from a private buyer, seller of cryptos, as you did with converting a currency, let's say, with a foreign exchange dealer that accepts it. It's a very similar kind of problem, so to speak, here, to convert these. Now, finding a private seller of goods who is comfortable with a currency can be a pretty big hurdle. And indeed, rather, it makes it particularly tedious, therefore, to engage in these transactions, unless you live, as I said, in the 2 countries that have adopted it officially on par. Okay. Now, despite its marketing and promotion of this currency, it is a currency that fits the needs, especially we've seen, of the illicit sort of underground economy, more than it does for normal kind of commercial, transaction activities in the marketplace. Indeed, some would say that it's almost the Wild West of financial speculation and illicit behavior. Just yesterday, and I'll stop with that, just yesterday, I have here one example, which is Do Kwon, who is the founder of Terraform Labs. That is the company that was behind the algorithms of stablecoin, Terra US dollar, and Luna, and which combined now at the time was worth around 60 billion US dollars, which collapsed and reached near to nothing recently. Okay. And now both the South Korean authorities and Interpol are after him. There's a global arrest. So this is the kind of stuff going on there. Okay. But there's also the other side of the coin, which of course is that in response to this need as well, central banks have started to consider, some have already implemented, but some are considering central bank digital currencies which would be legal tender in a country. Now, a good recent example, of course, is China's digital currency, which, as you know, just came out recently, which is referred to often as the digital yuan or the electronic or e-renminbi here, the e-RMB one here, etc. But there are many examples, and we will be discussing that with the two speakers. Now, let me present to you very briefly the two distinguished speakers that we have today. We will begin, and we've done this basically in alphabetical order when we set up the session. We will start with doctors, Andres Araus Galarza, and followed, of course, by Ulrich Bindsell. Now, Andres Araus is an Ecuadorian economist. He completed his PhD in financial economics at UNAM in Mexico City. His research work focuses on banks, cross-border payments, technology, and public sector. He is a former presidential candidate. In fact, he was the runner-up in the 2021 elections in Ecuador, just last year. And he had been under Correa, he was the Minister of Knowledge and Human Talent, former Vice Minister of Development Planning, and former Chief Operating Officer of the Central Bank of Ecuador, where in fact I first had knowledge and contact with. He was the architect also of the world's first central bank digital currency at the Central Bank of Ecuador. Okay. Arauz transformed Ecuador's national payment system in favor of technological and economic inclusion of the popular and solidarity financial sector. He sat on the boards of Ecuador's Tax Committee, Foreign Trade Committee, and Public Debt Committee. He has worked together with civil society organizations from around the world on tax justice, illicit financial flows, and monetary reform, and has done consulting and advisory work in these areas. He is also the leading researcher and supporter of special drawing rights and leads, or SDRs, for those from yesterday who were confused as to what the SDR term stands for, the IMF's SDRs, or special drawing rights, and also leads Ecuador's Observatorio de la Dolarización. Now, I should also mention that there exists an important publication that participants here can consult. It's a piece that was published last year, in the fall 2021 of the International Journal of Political Economy, titled The International Hierarchy of Money and Cross-Border Payment System, Developing Countries' Regulation for Central Bank Digital Currencies and Facebook's Stablecoin. The second speaker, and then we'll go to the presentations, is Ulrich Bindsell, who is the Director General of Market Infrastructure and Payments at the European Central Bank, the ECB, a post that he has held since November of 2019. Previously, Ulrich was Director General of Market Operations from May 2012 to October 2019 and head of the Risk Management Division between 2005 and 2008. He first entered central banking, however, in 1994 when he joined the economics department of the Deutsche Bundesbank, having studied economics. Now, his publications include some very important ones. One is the Monetary Policy Operations and Financial System at Oxford University Press in 2014. There's another one that I'm quite familiar, Central Banking Before 1800, a rehabilitation that came out in also at Oxford in 2019. And recently with A. Fotia, at Springer Verlag in 2021, he also has a book on Introduction to Central Banking. Now, I should also mention that an important publication that participants here can consult online is the piece published in the winter of 2019 of the International Journal of Political Economy titled Central Bank Digital Currency and Financial System Implications and Control. Having introduced both, I will start now and share a screen here to give you the first here. It's, as I said, he literally videotaped taped this last night, probably during the night, God knows when, because we got it this morning, just to show you that he really wanted to participate, but was blocked because of the way they canceled flights and stuff. And I won't even try to explain this to you, but he obviously couldn't be here. But he did, in fact, in this case, want to share a video here. Okay, so let me get to it.
Hello everyone, I must start thanking Mario Seccareccia for hosting this panel, Roy for the invitation, G78 and the organizers, thank you very much for having me here. I'm deeply sorry that I can't be with you in person or online. I had to tape this video only a few hours before, but an inescapable commitment that I have to assume has shown up out of my control. So today I'd like to talk to you about innovation in financial technology from a developing country perspective, And this is important because we as developing countries have a different set of urgencies and priorities and areas that are perhaps blind spots or oversights when being discussed at the center of the money systems. I'm talking about basically Europe and North America and increasingly even China. Developing countries have different concerns, and the bottom line is that developing country policymakers have to be much more proactive about the digital money transformation that we are undergoing right now in the planet. So let me begin with a few contextual elements, and then I will go into proposals and recommendations as to what we can do. I think there are risks of deepening privatization, deregulation, and instability of the financial system, of the monetary system, in particular of the developing countries, if the entire fintech agenda, and I'm including there cryptocurrencies, stablecoins, CBDCs, even some financial technology used by governments themselves, if this is not acted upon by progressive forces in developing countries. For example, we have small developing countries that are being used as experimental grounds for the large corporates to implement payment systems, to implement artificial intelligence over their credit systems, for the privatization of the people's credit data, and so on. We see increasingly huge dependence on domestic central banks outsourcing their core payments technology to foreign suppliers and foreign providers. This is a huge vulnerability in terms of their digital sovereignty, but also in terms of their monetary sovereignty. So we have to try to get people interested in the fact that the money framework is a good option for a digital transformation and digital sovereignty program in general, as it requires large amounts of data. And fortunately, there are sources of finance to invest in that in the domestic policy frameworks. And I'm talking about central banks, public banks, sometimes state-owned commercial banks, and the domestic payment systems that have traditionally, but not always, been an asset of the states, of governments in each of the developing countries. Now, there is a risk of deepening privatization of the monetary space, and I would like to pinpoint a few of the things that are going on. Most recently, and specifically in Europe and certain OECD countries, you have PSD2, which is a policy directive that basically commands for the banking system to become open. Now, that all sounds very nice, but it depends to what degree and what we understand by open. You can understand it by, perhaps having more competition among banks, displaying more information, being more transparent about their products and services, about the types of accounts they have, about how much transactions cost, and about what their rates are in terms of their loans. That sounds very nice and that's important. But there's a component of open banking that wants to make accounts basically portable, to move from one place to another with very light effort on behalf of the user. It also means opening the back office and the data within the back office of the banking system to certain technological corporates. Now, perhaps if you are a small entrepreneurial fintech and all of a sudden you have access to all of the accounting data, all of the transactional data and so on of a private commercial bank, that could be a treasure, a wealth of information that can be used to create new products, develop new services, and would really be a way forward. The reality is that unfortunately, those who probably would be most likely to benefit from this type of measure are going to be the large big tech companies that already have an outsized influence on society and have an outsized amount of our personal data, such as Google, Microsoft, Amazon, Facebook, IBM, Apple, and their Chinese counterparts like Alibaba and Tencent. So do we really want to open banking to these corporates so that they have even more power now also within the realm of the payment systems? Or do they just want to put themselves in the middle of the payment process so they can gather all this data and information and take advantage of it as well? Is that in the context of surveillance capitalism or in the context of, consumer benefit? And if you think about it from a developing country perspective, there are even additional worries in terms of the sovereignty of your financial system, of your monetary system, where key providers, where key information are going to be outsourced, and even without the risk of, that data being stored and manipulated and used outside of your domestic territory. So the data localization issues are also very important within a developing country perspective. I would also like to talk about the degree that cryptocurrencies affect the basically policy framework of developing countries. I have seen that cryptocurrencies have started occupying a lot of very valuable talent and energy and entrepreneurial spirit that would have been much more useful for developing countries in industry and high-tech services and so on, but unfortunately is being lost to the speculative dimension of the cryptocurrencies, right? So how to make easy money, how to basically jump from one to the next without really creating a fostering framework for the development of productive initiatives for a society. And once that I'm there, I also want to mention that there are particular worries about the cryptocurrency space, and especially cryptocurrency stablecoins, and it's the phenomenon of dollarization. What I mean by this, when you look at cryptocurrencies and how much they are worth or what's their value, you never, or very rarely, do you see how much they're worth in terms of euros or pounds or Canadian dollars. you will see that the value of cryptocurrencies is always quoted in US dollars. And this increasing dollarization of the cryptocurrencies has led to the fact that now one of the most important cryptocurrencies is actually a stablecoin, or a series of stable coins that are tied to the dollar as the sort of worldwide unit of account. This already has a few implications and a bunch of risks, but in terms of basically what could happen in terms of a bank run, or the equivalent of a bank run against a stable coin, whether the money is backed or not, how liquid the backing is, and so on, that I don't want to necessarily get into. But I do want to get into an issue of currency substitution. I wrote a paper a few months ago, published at the International Journal of Political Economy, where you see that I am very worried that stablecoins, the paper is specifically about Facebook's stablecoin and their WhatsApp huge network. I'm worried about the fact that they might want to dollarize even small, tiny domestic micropayments within developing countries. So for two people within a developing country like Guatemala, they want, Facebook wants or wanted to have the payments between them to be in dollars and executed through the WhatsApp payment system and settled with a privatized stablecoin denominated in US dollars. Now, can you imagine, with the huge network that WhatsApp has, it would be extremely damaging to any national currency, any domestic currency, if that would be allowed. However, this risk is there, it's not imaginary, and the dollarization of payments and micropayments, especially with the support of the big tech companies, is a real risk. And there is something to be done on behalf of policymakers. And developed countries should not ignore this fact. They should alert their counterparts in the South, in the global South, and say, look, you are under the risk of currency substitution, and perhaps there should be active and proactive policy on this regard. And I think the policy framework in general to deal with these issues of sort of veiled privatization, deregulation, and the instability that may be caused by the crypto and the fintech agenda has to do with constructing and building, especially in developing countries, homegrown central bank digital currencies, right? So forget for a minute about the digital euro, about the digital US dollar, about even the initiatives that have sprung elsewhere, because those are also threats indirectly to the developing countries if they are not regulated correctly. For example, can you imagine if all of a sudden a person in Argentina can have an account with the Fed, with the central bank digital currency of the US dollar? Can you imagine the level of capital flight that you all of a sudden would see if such a technology and means of payment was available universally to the whole planet? That's why the US, and if they care at all, in Europe as well, and so on, will have to put in safeguards to avoid this massive capital flight and currency substitution to the hard currencies that exist in the world. And if they don't do that, well, countries cannot rest idle. They have to put certain controls that would unfortunately have to do with regulating the space of the internet as well. And I'm being very serious here. The risk of retail level capital flight and currency substitution is not a minor issue for developing countries. The alternative is to build a domestic framework, a central bank digital currency framework with open innovation. And what I mean by this is that we don't just want the central bank to design a central bank digital currency and try to find all the solutions by itself. We want the central bank to develop a framework where the entrepreneurial spirit, where you can get the needs of the productive sector, where you can have proactive financial inclusion policies, where you can have APIs available so that many more participants are part of the domestic payment system, right? You need to build a digital commons so that the data that is a consequence of opening up the central bank is also available to entrepreneurs, to the research initiatives, to the local universities and so on, so that the data becomes the input for new developments in terms of new products and services in the domestic framework. So I think we need an entire policy arena that goes together with the central bank digital currency that's really about the democratization of the domestic payment system and the data of the payment systems. I also wrote a paper that you can find online called The Data of Money, where I analyze how the data of payment systems and financial transactions are stored and how that can be actually repurposed for research and development purposes. And I'm talking about development of countries, right, in terms of the development policy. So I think that's very important. But there's an added benefit to developing central bank digital currencies in this open framework. And it is the fact that citizens will now have a direct link to their central bank. Right now they have an indirect link via the physical banknotes, right? The bills and the coins. But it's an indirect, it's a distant link where people do not have a close relationship with the institution. By creating a central bank digital currency, even if it's on an app or on an even more generic framework where the citizen can connect to their central bank, that will create inevitably a dynamic effect in the democratization of central banks. Why? Because now if every citizen has an account at the central bank or a digital currency wallet with the central bank, they can complain about how the app is not working, about how they would love for the app to have a different option or a different menu, about how the app is not inclusive, about the biases that are in the app, about how it ignores certain components of society and so on. And this is important because it starts to put the central bank in the discussion of people. And unlike many who think that central banks should be kept as a secret element of the monetary system or government, I think central banks should be democratized. They should be opened up. It should be the discussion of citizens in their day-to-day about what's going on with monetary policy. And I think that discussion will then become a political discussion about how open, how democratic, how accountable central banks are in our societies. And it will lead to major policy change in the global institutions about the degree of autarky and basically a distance from democratic institutions that central banks have had in the past. Finally, I think that central bank digital currencies in developing countries have to be designed with the appropriate safeguards in terms of privacy, personal data, and what I call individual sovereignty that resembled the physical banknotes, but with an improved version. Because I also think that developing countries have to have the capacity to regulate and to apply policy measures onto the central bank digital currency. And the best way of doing that, of preserving both privacy and having the policy tools still available, has to do with zero knowledge proof technology, which basically means that you can own an account, but the account institution behind that account does not necessarily know who you are in terms of your name and last name, your address, and your personal data, but it does know what type of person you are, whether you're a citizen or not, whether you're a resident or not, and what type of sector you work in, whether you're an employer or an employee. And all this can be verified by third-party technology and with zero knowledge proof design systems, so that the personal data itself does not have to be given to the bank, to the central bank, but the key data about yourself, the qualifiers, but not the actual personal information, can be administered. And that will allow the policymaker to establish rules and what we now know as programmable central bank digital currency in terms of different sectors of society and whatnot. Finally, one major idea, and it has to do with the use of data. Developing countries have major issues with tax evasion, capital flight, the fact that many of their payment systems have been transnationalized, and most of their local elites don't even hold their money within their countries, but they deposit their wealth in offshore financial centers, and sometimes even, and especially in the United States, Miami comes to mind when I think of Latin American elites and where they stash their money. Now that's important because all of this happens with misuse or with faulty mechanisms that basically evade taxes, but they also evade exchange controls, and they evade the domestic payment system with international and cross-border transactions. Eventually, this money does become visible at one point in time to the payment systems, but it has not been analyzed in a complete and exhaustive manner by developing country policy makers. Sometimes they say, we need exchange of information from the rich countries, and that's very good. You get the information so that you can try to determine where the differences are and whether they have reported the money that they have abroad to the domestic tax authority or the exchange control authorities. But most of the time, a bunch of information arrives and it just rests there in some server, in some hard drive somewhere. We need a proactive data policy with the artificial intelligence components so that tax authorities, central banks, exchange control authorities can have automatized processes for checking for tax evasion on real time using payments data. And that will actually be a big qualitative jump in terms of the capacities of domestic policymakers in developing countries in order to safeguard financial stability and of course development-oriented monetary policy, right? So if there is a proactive monetary policy that creates money, that puts money into circulation in the domestic economy, but you have a vulnerability with lots of capital flight, then your policy has less chance of success. So with a good digital commons, with regulatory technology, which is called RegTech, with enforcement of that technology, enforcement technology called SubTech, we need to go forward with these innovative instruments to make sure that there is no tax evasion, or that we can minimize it with the technology currently available but not widespread in developing countries. So bottom line, developing countries have to be much more proactive about the digital transformation and its impact on the money systems that we are undergoing right now, and hopefully Canadian policy makers and the development cooperation agenda can also help in that regard. Thank you very much for your attention. Thank you for the space that I've had to share these ideas with all of you. Goodbye.
Okay. I mean, I would love to thank him, but unfortunately, he's still in flight somewhere, probably. But I will like to proceed at this point, and we'll keep the questions to the end after the second speaker here, our second distinguished speaker, will be addressing his concerns regarding, in this case, the idea of central bank digital currencies. Okay, and I'll leave Ulrich now to proceed with that. Thank you.
Yeah, thank you, Mario. And I really liked what Andres was saying. I could subscribe to everything. And I would like to tell him, don't worry, at least about the digital euro, because the point on capital flight issues is fully understood. You know, we would not allow for a usage of digital euro abroad unless, you know, there's a full agreement with a country and everybody agrees that it makes sense. So I would like to reassure him, but he cannot hear me. So let me go to my presentation. And I have a slide deck, and I will squeeze it a bit because I have too much material now for the remaining time. So, and that is really now a euro developed area perspective, which is a bit different. So let me start. Why CBDC? Again, a bit of general, you know, philosophy of why we work on CBDC as central banks. And, you know, here I don't go to the detail, but let me just say one point. Why CBDC is to a large extent the question, why central bank money? Why offer central bank money and not rely exclusively on commercial bank money? And there's a number of general reasons for the usage, the availability of central bank money on top of commercial bank money in the economy, which all apply in principle to CBDC, because CBDC is the answer to digitalization, to a future world in which all payments are digital and in which cash, so banknotes, would no longer play a role. So offering CBDC is a matter of maintaining the availability of central bank money to non-banks. And I say very few words on history. I mean, some people say, wow, how can it be central banks offering deposits? I mean, they think central banks always offer banknotes, so they find it revolutionary that central banks would now offer deposits. But the truth is, the first central banks did offer deposits and not banknotes. So the early public banks, starting in the early 15th century, they offered deposits as means of payment, and they were massively used. And only in the 17th century, the first publicly sponsored banks started to issue banknotes. And then in the 19th century in particular, banknotes became the standard. I mean, banknotes in the pre-online world, banknotes have the big advantage of for allowing, you know, surface economies to be supplied effectively with central bank money, while a pure public deposit bank, a Giro bank, is something more for a city-state, you know, like Barcelona or Hamburg or whatever. But Sweden and England, there really the banknotes became popular. But it's not the first form of central bank money. And if we return to, if let's say banknotes are no longer used, we return purely to deposit money, now electronic by central banks, you could say it's a return to the origins of central banking. It's not so revolutionary after all. And I skipped this one. This is, you know, an overview of historical, current, and future means of payment and categorizing them across 6 categories, like their format, the issuer, the access, the recording, the legal basis, and the connectivity. And Mario, you spoke quite a bit on Bitcoin. and Andres also referred to it. I found you, Mario, you were too friendly still with Bitcoin. Bitcoin is something unsuitable. I mean, people, as Andres was saying, it is a speculative asset. I mean, it absorbs a lot of resources, not only energy that you mentioned also, but also talent. So people spend their time in, setting up this Bitcoin economy, in speculating, in hoping to get rich because the price of Bitcoin would increase. So that is all not good. But it's not the topic of my speech. It's one of the reasons maybe to also issue CBDC, but we would say unbacked crypto assets like Bitcoin are anyway not a good competitor, for as a means of payment, while stable coins are potentially. So that's maybe more relevant for CBDC. And yeah, as you all know, probably CBDC is a hot topic in various countries, and as we learned from Andres also, it's in all parts of the world, so also in developing countries, and there it has, big potential in terms of also inclusiveness, which is a bit less relevant in the developed world. But there are various reasons, to issue CBDC. Some are stronger in some economies than in others, but the trend is clear, and the trend is not surprising, because the overwhelming argument is maintain a role for central bank money in a digitalized economy, where if the central banks would stick exclusively to 17th century technology, being paper money, they would phase out this service to society. They would lead, monetary systems in being something very strange. I will talk more about it. There are four perceptions of CBDC: negative ones, then idealistic ones, as I call them, and the pragmatic ones of central bankers. So there are lots of negative views, in the US, you find them, I think, mainly in the Republican Party, where there's not much enthusiasm for CBDC. I don't go to the details of those negative views. There are two variants. There's a fearful view that says CBDC, is a monster. It will destroy the efficient credit allocation. It will undermine banks' financial stability. It will lead to total control of money flows by the state. Or the dismissive negative view says it's not needed. It's a solution in search of a problem. It's just nonsense to do it. Okay, that's not the view of central banks. Then there's also an idealistic view. One view is that CBDC is a great way to eventually overcome commercial bank money and its perceived negative role for financial stability. So with CBDC, you could say now everybody moves to zero payments and zero accounts in central bank money, and banks would be prohibited, let's say, to issue sight deposits, and that would make the world a better place, more financial stability, no bailing out of banks in financial crisis, and central banks have great economies of scale in issuing money, so it's an efficient system. Central banks are shy of this. I mean, they don't take such idealistic views. They just say, if paper money is not used any longer, then CBDC is a conservative tool if you want to preserve the role of central bank money, to preserve the two-pillar monetary system relying on coexistence of commercial bank money forms and central bank money. And that has served us well. And that keeps, content in the convertibility promise inherent in private money, because what is private money is then a convertibility promise. No, you could say, if I have a commercial bank money, what is it what I have? I have a promise of a bank to convert it anytime I want into central bank money. If central bank money stops to exist in practice, then what is this convertibility promise? How do we preserve, a meaningful monetary system at all? That's why we need That's why we need CBDC. And then CBDC has, a lot of concrete then advantages if one maintains it. I mean, first, payments is a network function. You always end in a situation with market power of few providers. And if you keep a public offer, you contain the space for market abuse of private players dominating the market. You maintain also strategic autonomy internationally. That was something also Andres said clearly. So that applies both to maybe a developing country and the euro area. The euro area being already now quite dominated in terms of retail payment instruments by non-European companies, which are very successful for good reasons. They have good products, but there is maybe a limit where you find this dependence on few big international players very, comfortable from this autonomy and competition perspective. I think I said all this. Let me skip this. Let me move to the digital euro project. And this is now a kind of more official part of my presentation, where I will tell you how strictly, this project is justified and the time plan and a few things. So this is how it is officially stated by our president. So it aims at ensuring that in the digital age, in the future, citizens and firms continue to have access to the safest form of money, central bank money. So we began with an investigation phase of a project on 1st of October 21, and this will last for 2 years. So this is again, the official terms we use to justify the digital euro project. I think I mentioned all that already in the general CBDC discussion. And then, of course, once you launch a project, you face a lot of very practical questions. So if you scratch the surface of the, I would say, relatively obvious idea of CBDC, then you discover that there's a lot of questions to specify. It's not so trivial. And of course, here just quickly, you have the end user perspective, you have legal issues, you have the back end, so the settlement layer. You have to decide on how you offer it, what form factors, mobile cards, online access. And you have also distribution framework issues, how you convert commercial bank money into digital euro, how do you convert cash into digital euro. So the project, here's again the timeline: investigation phase 2 years, then a potential realization phase, then potential issuance eventually. And I think one thing where we can now say that the euro system, have moved faster and more aggressively than comparable monetary areas is that we really launched a project. And a project means, you have milestones, you have deliverables. At the end of the investigation phase, you have to come up with, user requirement documentation, technical specifications. Those are really very comprehensive documents that you have to put on the table, which are then the input of the realization phase, where really the programming takes place. And most other central banks are more, in an analytical phase still, not, submitting themselves to a very, one could say, rigid framework with deliverables. I think we are now moving quite aggressively, although we say we have not decided, to issue, but we are moving aggressively in designing the digital euro, and then maybe in the next phase in making everything ready for it to be issued. And what are the questions, to be covered in this investigation phase? The use case is very important, which type of payment cases do we want to have covered in the digital euro? what interaction with the existing, very developed European retail payment ecosystem, how, who will distribute digital euro? Lots of questions. What will be the business model of the digital euro? Every electronic means of payment has a business model. Like, for example, the card business model. Typically, the merchant pays a fee, and this fee is distributed to the issuer of the card, to the scheme owner. So what will it be for digital euro? I mean, who will pay what? Who will receive what in the private sector in this ecosystem that is supposed to handle the digital euro in practice? Features, functionality. I give you one example. Should we have offline capabilities for digital euro? One view is, all electronic payments, retail payments are online those days for maybe good reasons, because it's more secure. And if anything, we have online everywhere now. So why the pain of developing offline payments if it's more difficult and risky? On the other side, people say, look, you plan for substituting banknotes in the future. So better, you try to also capture some of those features of banknotes, like offline capability. That makes you more resilient, because there can be an internet, malfunctioning, and then, preserve those properties of cash that are so fantastic. To not rely on electricity, even not rely on online, and also be inclusive, maybe as one feature. Then you have legal questions. So we are in intense discussions with the EU Commission, the legislator, which will have to accompany this process. And then, what technical solutions, in terms of technology. Example, do we need distributed ledger technology, or should we rely on a central account system? And, here also the standard for electronic payments those days is account, a central account, and not distributed ledger. And frankly, my own intuition is that this is for good reasons, and we can stick to it. Legal issues, let me not go into the detail, but one thing is, what is the enabling law? What is the basis for it in the EU treaty, in our statutes? Will it be a legal tender? Is a very good question. So what compliance will it have with AML CFT rules, so anti-money laundering, data protection, privacy? Is it a standard electronic means of payment, or is it treated differently because our legislator wants it to be different? And privacy, for example, we as central bank, we say we are not in charge, of choosing for society what degree of privacy a digital euro should have. It should be the legislator, who can decide for society on the trade-off between, let's say, anti-money laundering and privacy. It's not the central bank who should claim to be able to take the choice. Business model, I mentioned already. And then, we have lots of trade-offs where you really have to find the good good solutions. And it's not easy. Here, one example. On one side, we want to minimize industry investment costs for implementing a digital euro, speaks in favor of synergies, of not being too creative, let's say. At the same time, we don't want to be too dependent on the industry. The whole idea is to have an independent central bank money-based solution. We also want to offer a distinct value proposition to consumers. So, the consumer should feel that the digital euro is not just, what it has already, but is something special. And we don't want to crowd out private initiatives. So that, is not partially those things compete with each other, and we have to make the right choices. And of course, we are there to serve the citizens. So we want this solution to be convenient, obviously as convenient as the best private solution. We want universality of use. So the payer typically wants, one mean of payment, one instrument to cover all use cases, doesn't want to have 10 different payment instruments, even in her or his mobile phone, wants one wallet which allows all use cases. And then the question: do we want to cover functions not yet covered by private solutions to have a value added beyond the idea of competition and sovereignty? So one thing is the offline question. Maybe it's not offered by the industry now because there was no demand. There were attempts to it. There was no demand. Okay, I already mentioned the considerations. Inclusiveness. In Europe, the large majority of people is banked, has a bank. Those who are not banked are more complicated cases where you have to, spend money and effort to also onboard them on digital euro. So maybe you need special hardware, you need special customer support. So it's not so trivial, while in a country where you have a lot of unbanked people, but who have mobile phones at the same time, I mean, the inclusiveness effects of CBDC can be fantastic and can avoid that financial inclusiveness at the end is achieved via stablecoins, foreign stablecoins, crypto assets, which have a lot of drawbacks. And privacy, I mentioned already. So yeah, that's it. I hope I didn't rush too quickly through the slides, and I will stop sharing. And back to you, Mario.
Okay, thank you. And I would now like to get started with the questions and answer period here as quickly as I can, because we are, already out of time almost here, but we're going to take at least another 10 minutes to get some questions through here. And I could just ask one, and then we could get started. I'm going to check the questions and answers on as well that are available that I'm going to read in a minute here. But I'd like to start with one that I really appreciated, Ulrich, what you did in terms of giving a bit of a historical sort of account of the fact that this is not a new idea. At all. And going back literally to the Middle Ages. But what we've seen historically, of course, is that banks, private banks here, commercial banks, chartered banks, as we call them here in Canada, have played a dominant role ever since. They emerged in the 18th century, literally. They in those days, they issued their own banknotes that circulated. Okay, after the Gutenberg press, there in a sense, that became a possibility. But also, by the time we get to the 19th century, we got the dominance of deposit money here, if you wish, as it emerged by the mid-19th century, for instance, in places like England, even in Canada here. Okay? And what we see, therefore, is the dominance, really, of banking, in a sense, in providing these means of payments. Okay, which has been extremely profitable for banks, to say the least. Yeah, okay, in many ways. Yeah, and indeed, in terms of user fees, especially nowadays, that is where they take the biggest cut, more so than other forms. In terms of the usual interest spreads form of revenues. And what I'd like to ask you is a political question. I don't know if you'll have an answer to that, but you do, in fact. I think you have raised it already, which is, how do you deal with the possible opposition from the banks? Because, of course, this will mean a major cut in their revenues, you would think, if the public does take on big times here in using having a central bank deposit, in a sense. Okay.
Yeah. Good, very good question. And indeed, banks tend to dislike CBDC. Although in Europe, we have so far a rather constructive process. Central banks, don't take this idealistic perspective that they actually say, we don't want to crowd out the private sector. They say, we will limit the total amount of CBDC that people can hold. We can take a reference to banknotes and see in the euro area the amount of banknotes in circulation, and we are a bit saying we don't want to go beyond that. And with electronic payment instruments, you can limit, the total amounts. You can disincentivize large holdings. So that's the first element, to appease banks, if I may say. And the second one is in the means of payment area. So, one thing is store of value of money. So we say we will limit it. The other is the means of payment. So in what use cases would we enter? And for example, we say we will not compete on commercial bank money-based deposit transfers, what we call in Europe the SEPA payments, the credit transfers, what European banks are covering successfully. We don't go into this business. We see ourselves, and that's a use case question, more in the point of sale and e-commerce, where anyway maybe foreign companies have been dominant and European banks not so much maybe. But it's clear we try to tell the banks we don't want to crowd you out. We only want to maintain a role in a future digital world. The current, transactions done via banknotes are migrating into an electronic space, and the central bank migrates into the space together with those volumes, so that there's no need of a net crowding out of banks.
Okay, thank you. I would like to now there are two questions that have been, that appear on the Q&A here. I have one from Eric Heiliner. I'd like to know more about the cross-border side of the digital euro project. You mentioned this at the start in the context of Ecuador. I may have misunderstood, but did you say that non-residents in Ecuador would not be able to hold digital euro without the approval of the Ecuadorian authorities? And then he goes on, ECB officials often highlight that the digital euro is needed to defend monetary sovereignty. Is that a reference to the strategic autonomy issue that you mentioned?
Yeah. Second question, clear yes. Yeah, that I use the term, interchangeably. So strategic autonomy, monetary sovereignty, it's the same. At least I use it in the same way. And the first question, yes. I mean, we want cross-border use, but only with conversion of currency. So let's say Ecuador has a digital currency. We have one. And we want that transfers, ideally, one day in the future, that I can make a payment from my digital euro account to the account in Ecuador of someone I know, and that there is a currency conversion layer in between, so that, there's no dollarization in Ecuador. There's no cross-border holding of euro. It is, in our view, cross-border usage should be including FX conversion, so to avoid, that you have capital flows. And we would not do it anyway, anything without the approval of the local authorities and in the context of a framework of an agreement. Because also we don't want those capital flows. No, we don't want that the ECB balance sheet explodes because half of the world is keen to hold digital euro. Absolutely not. So let's say we have the same interests anyway.
Okay, thank you. There's another question here from Manfred Binfeld. He says, both of these brilliant presentations focus on our earlier discussions by seeking to meet the challenge of electronic payment systems while retaining or even strengthening the capacity of central banks to play a role in allowing national priorities to be reflecting in and facilitated by financial payment systems. They therefore both remind us that we face both an enormous threat in the form of money being excessively privatized, but also a real opportunity to design a system that could allow sovereignty to be better protected. But the second possibility can win out only with the requisite political support and our ability to design central bank digital currencies in a form that is workable and acceptable enough to be implementable. And it's more of a commentary here than a question, but perhaps if you would like to comment on that, Ulrich, please feel free.
No, I think it's a comment, and it's a good comment. I have nothing, to say against it. Maybe just to complement, I think if we want CBDC to be successful, we can make it successful, because as a central bank, we have some natural, I would say, competitive advantages. We have, of course, the security, the absolute security, the liquidity, the absence of credit risk, and we have also the economies of scale, maybe. We can enter the market aggressively. And then further advantage we can have is legal tender status. I mean, if we have legal tender status, it's a big advantage, no? And finally, we can also, in theory at least, we could say it's a public good. We pay for it. Merchants don't have to pay, and then merchants will love us. Merchants will say, pay in digital euro, pay in CBDC, because I have no merchant fee. While, if you pay with a credit card, you have a merchant fee of a few percentage points. So we can make it very successful. I have no doubts on this if we are aggressive. I mean, however, central banks have taken this cautious attitude to say we don't want to crowd out. And that is not so easy in a network function like payments to you want to be successful, but not too successful. And in a network market, that's not easy, to land in the middle. As long as central banks offered banknotes and the private sector electronic means of payment, let's say there was a stable equilibrium more easily, because the two products were quite distinct. But now central banks move into exactly the same space. They could win the space. I think they could crowd out everyone if they take it very aggressively, but they don't want to. So how to exactly, design a stable coexistence becomes more tricky. But there's no doubt we can be very successful, and we can also fail and be unsuccessful, but we want the middle ground, and that's the most difficult, maybe.
Okay, thank you. Actually, you anticipated the third question here. That is exactly, I think, on that, which I'll just read it, but I mean, you seem to have answered it for me. Thank you so much. This is from Guillermo Matamoros Romero. Thank you so much for your excellent presentations. Just a quick question as a follow-up of Mario's point. What would be the problem of crowding out commercial banks if CBDC do a better job? Many thanks again.
Yeah, that's I would say, idealistic view. And, in theory, one can take it. I can only say central banks have not taken it because they, maybe they're just conservative by nature and they don't want a massive pushback, maybe whatever the reasons are. We believe the coexistence is good. To find arguments on substance, maybe the private sector is more innovative, more flexible. And if we make the monetary system a pure central bank money based one, maybe we lose this innovation, this tendency to innovate. Although even for CBDC, our idea is, to embed it and to allow private sector to build, applications on top to remain innovative. But it's an excellent question.
Okay, I guess at this point I would have to, we're already over time here by 18 minutes, so I don't want to keep people any longer. actually, there's another one that just popped up here, but I think we'll have to stop here. I will let at this point Roy, if he wants to make any commentary, since this is the last session of the conference here that pertain to these various themes here. I would like to perhaps ask Roy if he would like to say anything here before we end the session.
Well, I actually had a question, and
Okay.
that was, would central bank digital currencies help to prevent or reduce tax evasion and capital flights from developing countries in particular? Just a quick one for Ulrich.
Yeah, I mean they could. I mean that's the question. I mean, society has to know what degree of information of controls to build into its digital currency, sorry. And the advantage of digital currency by the central bank is that the society can take a conscious decision, you know, how much control it wants, how much privacy. While, you know, if you push people to rely on Bitcoin or some stable coins, not only that they can lose a lot of money, but society does not control, you know, the misuse for whatever illicit purposes. So from this perspective, it's and that's exactly what Andres has been saying. It's sad, you know, if the advantages of digital money are not deployed in an orderly manner and controlled by society collectively, and, you know, just goes to some uncontrolled, intransparent, let's say, cryptocurrencies where capital flight and tax evasion and illicit payments, you know, can be done without much control.
Yeah. Thank you, Ulrich. And on that very helpful and promising note, or at least potentially promising note, let's draw this session to an end. I'd like to give my heartfelt thanks to both Ulrich and Andres, who's not online to hear these thanks, but I'm sure if he were with us, he would have enjoyed this conversation, and we could have also had a bit of exchange between Andres and Ulrich. And Mario, thank you to you for moderating the panel. This brings us to the end of our series of 3 substantive panels in our conference. On Friday, we're going to host a wrap-up panel, which will be led by some student presentations, which we're just in the process of working out with the students who have been rapporteurs to all of our sessions. But others are welcome to join in. That wrap-up panel will be on Friday, September the 30th, starting at 12 noon. And hopefully out of that panel, we will have the elements of key messages and recommendations coming out of the conference, as well as some summaries and synopses of the discussions themselves. So once again, thanks to all. Thank you very much to Sarah Bowles in particular.
Thank you.
Helping to navigate the technical challenges in getting our video from Andres up. And bon voyage, those who are traveling, including Andres, if he hears this at some point. And take care. We'll hope to see you on Friday.